Hello everyone and welcome back to my channel. In today's video, we'll be tackling some questions for the Chartered Wealth Manager Certification exam. This certification is recognized and is useful in many countries, especially in regions with a well-developed financial services industry. Some countries that this certification is useful for are the United States, the UK, Canada, India, Singapore and Hong Kong, and many other countries. So without wasting further time, let's dive right into the questions. Question 1. In the Transfer of Property Act, immovable property does not include A. Building, B. Land, C. Pond, D. Standing timber. A building is considered immovable property because it is fixed to the land and it cannot be moved. Land is the quintessential example of immovable property because this is part of the Earth's surface. A pond is also considered immovable because it is fixed to the land. However, standing timber, that is timber that is still growing and not yet felled, is not considered immovable property. It is treated as a type of personal property. It is when it is severed from the land, that is when it can be treated as a movable property. So, under the Transfer of Property Act, immovable property refers to property that is still attached to the earth and cannot be moved. So, this includes lands, buildings, and other things that are attached to the land. Looking at the options we have, out of them, the one that is not considered immovable property is option D. Standing timber. This is because it has already been severed from the land. Thereby, it now makes it a movable property. Question 2. With the increase in the age of investor, the risk appetite of the investor, A. increases, B. remains constant, C. decreases, D. any of the above. Option A is incorrect. While knowledge and experience might improve with age, the willingness to take on risk decreases due to several factors, such as the risk tolerance levels, financial goals, and the time horizon. In option B, risk appetite of the investor does not remain constant as their age increases. Risk appetite is dynamic and it tends to change with life stages, financial needs, as well as market conditions. For younger investors, they have a longer time horizon to recover from potential losses, thereby allowing them to take on higher risk. Older investors, on the other hand, or the ones that are getting close to retirement, they have a shorter time frame, so they are more focused on preserving their wealth than on aggressive growth. Older investors also prioritize a stable income and capital preservation to meet their retirement or legacy planning goals. So high-risk investments may jeopardize these objectives. Additionally, with age, individuals become more risk-averse because their ability to replenish lost capital diminishes. Out of the options, the best answer is option C. As the age of the investor increases, their risk appetite decreases because of factors like the time horizon, their financial goals, as well as their risk tolerance levels. Question 3. What is a contract? A. An agreement between two or more parties which creates no obligation to do a particular thing. B. A contract is an agreement between two or more parties that does not establish an enforceable legal relationship. C. Contracts consist of reciprocal promise that the law will not enforce. D. A contract is the result of a promise to do a certain thing in exchange for a promise from the other person who is a party to the contract. A contract is a legally binding agreement between two or more parties that creates obligations to do or not do certain things. This agreement is formed when there is an offer, there is an acceptance, and there is a mutual exchange of promises. So out of the options we have, the best answer is option D. A contract involves a mutual exchange of promises where each party agrees to do something in return for a promise from the other party. Question 4. Which of the following is the primary goal of wealth management? A. Maximizing short-term returns. B. Aligning financial strategies with a client's long-term goals. C. Speculative trading for high returns. D. Avoiding all forms of risk. Looking at option A, wealth management emphasizes long-term stability and growth rather than short-term. So this is often associated with high risk and speculative strategies. So that's not our answer. Wealth management is a holistic approach to managing an individual's financial resources, focusing on aligning their financial strategies with long-term objectives. So it considers factors like investments, tax planning, estate planning, and retirement planning. In option C, speculative trading is inconsistent with the goals of wealth management because wealth management prioritizes steady growth, risk management, and meeting the client's specific needs. And in option D, risk cannot be completely avoided in financial strategies. However, wealth management aims to manage and mitigate risks in alignment with the client's risk tolerance and goals rather than eliminating the risk entirely. So our answer here is option B. Wealth management aligns financial strategies with a client's long-term goals. Question 5. The cheapest form of life insurance which provides risk cover in the event of death of policyholder during policy term is A. Endowment insurance. B. Life insurance. C. Mediclaim policy. D. Term insurance policy. Endowment insurance combines life insurance with a savings component. It provides a death benefit if the policyholder dies during the policy term or a maturity benefit if the policyholder survives the term. Based on the question is asking for the cheapest form of life insurance. The endowment insurance is more expensive than term insurance because it includes both risk cover and a savings investment element, and this increases the premium costs. A term insurance policy is by far the most affordable form of life insurance because it provides financial protection to the policyholder's beneficiaries in the event of the policyholder's death during the term of the policy. Now, unlike the endowment policy, term insurance does not have a savings or investment component, so this makes it cost effective. Let's look at the other options. Option C, the Mediclaim or health insurance policies covers medical expenses related to hospitalization, surgeries, or treatments due to illness or injury. It helps to reduce the financial burden of health costs. However, it does not provide life insurance coverage or death benefits. It focuses only on covering the medical expenses and it is unrelated to life insurance. Term insurance provides pure life coverage for a specified period at the lowest cost. If the policyholder dies during the term, a death benefit is paid to the beneficiaries. If the policyholder survives the term, there is no payout. It is the cheapest form of life insurance, but it is designed solely to provide risk cover in the event of the policyholder's death. The question we have, or the scenario we've been presented with, is looking for the cheapest form of life insurance which provides risk cover in the event of the death of the policyholder during the policy term. So our answer here is option D, the term insurance policy. It provides financial protection to the policyholder's beneficiaries in the event of the policyholder's death during the term of the policy. Question 6. What is the key difference between strategic asset allocation and tactical asset allocation? A. Strategic allocation is for speculative investments, while tactical is for long-term goals. B. Strategic focuses on long-term goals, while tactical involves short-term adjustments. C. Tactical avoids risk, while strategic seeks higher return. D. Tactical is used exclusively for retirement planning. Option A is incorrect because strategic allocation is for long-term goals and not speculative investments. Tactical allocation focuses on short-term market adjustments and not long-term objectives. Strategic asset allocation is a long-term approach where the investment portfolio is designed to meet the investor's long-term financial goals. It involves setting a target mix of assets like stocks, bonds, and real estate based on the investor's risk tolerance, objectives, and time horizon. The allocations remains relatively stable over time with periodic balancing. Tactical asset allocation, on the other hand, involves making short-term adjustments to the portfolio to take advantage of market opportunities or to respond to changing economic or market conditions. Tactical allocation is more flexible and it aims to enhance returns or reduce risk temporarily while staying within the framework of the strategic allocation. Option C is incorrect. Neither approach is inherently about avoiding risk or seeking higher returns. Both of them, the strategic and the tactical, they aim to balance risk and return, but in different time frames. In option D, that is also incorrect. Tactical allocation can be used for various financial goals, not just retirement planning. And strategic allocation is more commonly aligned with retirement and other long-term objectives. So our answer here is option B. Strategic focuses on long-term goals, while tactical involves short-term adjustments. Question 7. What is burn a burn? A. Loan of a particular piece of property. B. Credit sale. C. Down payment. D. Deposits in trusts. Option A is incorrect because it doesn't describe burn a burn. It refers to something more akin to a loan arrangement rather than a down payment or deposits. Option B is also incorrect. A credit sale involves the buyer paying for goods or services over time, and this is not the same as burn a burn, where an advance payment is made to secure an agreement. Burn a burn is a term used in Islamic finance. It refers to a form of down payment made in certain contracts. It is an amount of money that is paid by a buyer in advance in order to secure a deal, especially in cases where the buyer wishes to purchase a property or goods in the future. If the buyer decides not to proceed with the contracts, the burn a burn is often forfeited or kept by the seller as compensation for the lost opportunity. In option D, a trust deposit involves holding money in trust, typically in a fiduciary capacity, and it does not fit the definition of burn a burn. So out of the options we've been presented with, the answer is option C. Burn a burn is an amount of money paid by a buyer in advance to secure a deal, especially in cases where the buyer wishes to purchase a property or goods in the future. So it's like a form of down payment. If the buyer decides not to proceed with the contracts, the burn a burn or the down payment is forfeited and the seller keeps it as compensation for the lost opportunity. Question 8. Which of the following is not a commonly used financial ratio in wealth management? A. Current ratio. B. Debt to income ratio. C. Price to earnings ratio. D. Human capital index. The current ratio is a commonly used financial ratio that is used to assess a company's short-term liquidity by comparing its current assets to its current liabilities. It helps wealth managers to assess the financial health of a company or individual in terms of liquid assets. The debt to income ratio is used in personal financial planning and wealth management to ensure the proportion of an individual's monthly income that goes towards debt payment. It helps to evaluate an individual's ability to manage debt. The price to earnings ratio is a popular financial metric used to assess the valuation of a company by comparing its current share price to its earnings per share. It is frequently used in wealth management for investment analysis. And the human capital index, this is not a commonly used financial ratio in wealth management. It is more of an economic measure that is used to assess the value of an individual's skills, education, and health, but it is not used in personal wealth management or investment analysis. So out of the options, the one that is not a commonly used financial ratio in wealth management is the Human Capital Index, option D. Question 9. Employees' Provident Fund is applicable to firms employing over dash employees. A. 20 or more. B. 15 or more. C. 10 or more. D. 25 or more. The Employees' Provident Fund Act in India mandates that the EPF scheme applies to establishments that employs 20 or more employees. This scheme is designed to provide financial security to employees after retirement, and it includes contributions from both employers and employees. So this is our answer, option A. Looking at the other options, in option B, the threshold for the applicability of the EPF is 20 employees, not 15, not 10, and also not 25. The EPE scheme is applicable to firms employing 20 or more employees and not 25 or more employees. So our answer here is option A. Question 10. Under flexible exchange rates, a small open economy should A. Lose control of its monetary policy. B. Be insulated from its trading partners' inflation. C. Tend to experience the inflation of its trading partners. D. Find that changes in its interest rates match changes in its trading partners' interest rates. For this, we'll be going with option B. Under a flexible exchange rate system, the exchange rate adjusts to balance the supply and demand for foreign currency. This system allows a country to maintain an independent monetary policy, and consequently, the domestic price level or inflation is less influenced by the inflation rate of trading partners because the exchange rate adjusts to offset external price changes. So that's why we're going with option B. Question 11. Fixed exchange rate systems maintained by a gold standard have difficulty achieving equilibrium if A. The money supply rises with surpluses. B. The money supply falls with deficits. C. Inflation of costs and prices occur with a balance of payments surplus. D. Changes in the money supply are unrelated to the state of the balance of payments. In option A, under the gold standard, a balance of payment surplus would lead to an inflow of gold into the country, and this would naturally increase the money supply. In option B, a balance of payments deficits will cause gold to flow out of the country, leading to a decrease in the money supply. This is a natural adjustment mechanism under the gold standard. In option C, inflation of cost and prices occurring with a balance of payment surplus is a key challenge under the gold standard. If a country experiences a balance of payment surplus, it accumulates gold, thereby increasing its money supply. However, if the country's economy grows too quickly or wages and prices rise, this can erode the competitiveness of the country's exports, potentially leading to inflationary pressures despite a surplus, and this will cause an imbalance in the long term. In option C, this will be a characteristic of a flexible exchange rate system, not a fixed exchange rate system. Under the gold standard, the money supply is very much linked to the balance of payments because it's directly affected by gold inflows or outflows. So out of these options, our answer will be option C. The value of a country's currency is directly linked to a specific amount of gold. This system has its inherent challenges when trying to maintain equilibrium, especially in the face of economic imbalances. Question 12. What is the significance of the risk tolerance assessment in investment planning? A. It determines the exact portfolio returns. B. It measures how much risk a client is willing and able to take. C. It avoids all forms of investment risk. D. It focuses solely on historical returns. Option A is incorrect. Risk tolerance assessment does not predict exact returns. It helps to design a portfolio suitable for the client's risk profile. In option B, risk tolerance assessment is a critical part of investment planning because it evaluates two key features or factors, which are the willingness to take risk and the ability to take risk. By understanding both aspects, a financial investor can recommend an appropriate portfolio that aligns with the client's goals and ensures that they are not exposed to undue risk. In option C, investment planning does not aim to eliminate risk because some level of risk is necessary to achieve returns. So this is incorrect, and option D is also incorrect because while historical returns may inform investment decisions, risk tolerance assessment is forward-looking, focusing on the client's current and future financial needs and comforts with risk. So our answer here would be option B. Willingness to take risk reflects the investor's psychological comfort with risk, which is influenced by personal preferences, past experiences, and attitudes towards market fluctuations. And the ability to take risk is based on the investor's financial situation, such as their income, savings, investment horizon, and financial goals. For instance, young investors with a long-term horizon and stable income can generally afford to take more risks compared to retirees. So by understanding the willingness to take risk and the ability to take risk, the financial investor can recommend an appropriate portfolio that aligns with the client's goals and ensures that they are not exposed to undue risk. Question 13. As per Rule 69 of Dublin, what is the doubling period if rate of interest is 9%? A. 8.5 years. B. 8 years. C. 8.4 years. D. 8.1 years. The Rule of 69 or the Rule of 70 in some variations is used to estimate the time it takes for an investment to double at a given rate of interest, especially in compound interest scenarios. So, with respect to that, the doubling period for an interest rate of 9% under the Rule of 69 would be approximately 8.4 years, and that is option C. Question 14. In dash, without delivering possession of the mortgage property, the mortgager binds himself personally to pay the mortgage money. A. Usufructuary mortgage. B. Simple mortgage. C. English mortgage. D. Anomalous mortgage. In option A, the possession of the mortgage property is transferred to the mortgagee, who has the right to use the property or receive its income instead of interest or repayments. In option B, in a simple mortgage, the mortgagor or the borrower binds themselves personally to repay the mortgage money without transferring possession of the mortgage property to the mortgagee or lender. If the mortgagor fails to pay the loan, the mortgagee has a legal right to sell the mortgaged property to recover the debt. In an English mortgage, the mortgagor transfers ownership of the property to the mortgagee, but retains the right to reclaim it after the debt is repaid. In option D, An anomalous mortgage is a combination of two or more types of mortgages or one that does not fit into the standard category under property laws. So, in the scenario we've been given, the best answer will be option B. In a simple mortgage, without delivering possession of the mortgage property, the mortgager binds himself personally to pay the mortgage money. Question 15. The suitability standard in wealth management requires A. Recommending the most profitable products for the advisor. B. Ensuring that the investment aligns with the client's financial situation and goals. C. Providing the lowest cost products available. D. Avoiding all investments with any risk. Option A is incorrect. The suitability standard prioritizes the client's best interest and not the advisor's profit. Recommending products that benefit the advisor over the client would violate ethical standards. In option B, the suitability standard in wealth management requires advisors to recommend financial products or investments that are appropriate for the client's financial needs, long-term goals, and risk tolerance. The advisor must ensure that any recommendations made are suitable for the client's specific situation rather than just focusing on profit or cost. Option C is incorrect. While cost is a factor, the suitability standard does not require choosing the lowest cost products. The focus is on what best fits the client's goals and not on cost. Option D is also incorrect. While risk tolerance is considered in the suitability standard, it does not require avoiding all investments with risk. It is about recommending investments that aligns with the client's risk tolerance and goals, and this may include some level of risk. So, the suitability standard in wealth management requires ensuring that the investment aligns with the client's financial situation and goals, and that is option B. This brings us to the end of the video. Thank you for watching. Don't forget to comment, like, and share, and also hit the subscribe button so that you'll be notified when our next informative video will drop. Thank you for watching, and I'll see you in the next video.